Hello, this is Ryan Ray of AAII, and I am your host for the Individual Investor Show. We are talking about the latest and greatest from the world of finance and investing for the individual investor. My guests today are AAII Journal editor Charles Ropeblut, our president John Bykowski, and analyst and editor of AAII's dividend investing portfolio newsletter, Derek Hageman. How do you invest in the macro environment of current events while keeping your portfolio strategy in mind? Today's episode gives tips on how to keep your asset allocation matching your goals and also explores the common characteristics of the top performing AAII stock screens from the last year. Plus, we also discuss how investors can keep their assets from disappearing in the event of a broker liquidation. Let's get started. All right, any time of the year is a good time to review your asset allocation and whether it aligns with your investing goals. But many investors may find themselves reviewing their resolutions at the beginning of a new calendar year, such as the one we just experienced. Charles, how do you go about setting your investing goals for the year and beyond?
Well, our goals are pretty simple for my wife and I. It really is funding retirement. But the other thing is making sure we have money set aside for both those unexpected emergencies and also for larger purchases, say a vacation or we need to replace furniture. It's pretty simple on our part. We don't have very financially complex lives, but other people might have multiple goals. Perhaps they're thinking about college, they're thinking about retirement, they're thinking about inheritance. Maybe they want to leave a large donation to their preferred charity or congregation. So it does vary. One of the things I do personally every year is I actually map out my savings for the full year. So not only do I have my goals, but I actually take time out to think, okay, every pay period, how much am I going to deposit? And I actually set up automatic deposits throughout the year. So this idea of saving before spending, I'm not making any decision to do it on a week by week basis. It's already set in. It just happens automatically when I get paid. And I think that's a very powerful thing to do because it's always easy to say things to spend on. There's always things that pop up, but if you can get that mentality and really have that practice set up where you're paying yourself first, then you can actually have your savings set up. But I do think it's important for people to really just stop and think about, why is money important? Why am I investing? What am I investing for? Chances are it's at least one thing, and maybe it's multiple things. But I think that's really key when you're engaging with your portfolio and investing, to really have that end goal. What is it for? Because chances are it's not just, I want to have money. There's probably a reason why you want to have money for, whether it's financial security, again, or maybe perhaps you're looking to pass along the money either to family members or perhaps for charitable purposes.
All right, so let's say I've sat down and I thought about it. I've set my investing goals. I know what my priorities are in rank order. But how should one handle their portfolio accordingly? Are there recommended models that might meet my priorities for risk and return? Is there some sort of guide that I should follow?
Yeah, Ron, that's a great question. One of the things I would suggest as part of the wealth building toolkit, we actually have a goals worksheet, and we discuss it and we highlight it in the January issue, and we've made some changes based on member feedback. One of the things we do, though, and you mentioned the word prioritize, is we do ask members to actually go through and prioritize their goals. What is the most important goal? What is the second most important goal, etc.? And think about, if you had to choose, what would be the one goal that's the least negotiable? What's the one goal that you need to fund above everything else? And that should really dictate your investing decisions. Now, let's say, for instance, you're a parent, and so you're really thinking about retirement. You also have kids you want to pay for college, or perhaps you're grandparents and you're thinking about paying for your retirement expenses, but you'd also like to help out, say, with your grandkids' college education. In that case, you want to think about those goals in terms of your overall wealth, and also the timing as to when you'll be spending on those goals. So if one goal's further out, you can invest more aggressively. One goal's shorter term, and then you need to actually account for those short-term cash flows. And so the reason why I'm saying this is because when you work through our toolkit, one of the things we have is a risk questionnaire. And in it, we ask you to consider the timing of your cash flows. The rule is, the shorter the period is till you need the money, the more conservative you should be. The longer the time horizon is till you need the money, the higher risk tolerance should be. But it also matters about how much of your wealth are you spending on it. So if your plan is to buy say make a down payment on a house within the next year, well, that's a pretty large sum of money, and that should be invested really conservatively. If you're thinking about, okay, when I retire and retirement's in 10 years, I'm going to buy a vacation home. Well, again, that might be 10 years in the future, which gives you some time, but then you're looking at a one-time large payment for that down payment. So you want to consider the timing of those goals, how much you're going to spend, but again, how much of it is it relative to your wealth? So if you say you're age 55 and you're going to plan to retire early, maybe at age 62, but you have a pension and you're going to maybe claim Social Security early, well, that might account for most of your living expenses, so you don't necessarily need to take a lot out of your portfolio. So you really want to not only consider the time elements, but again, how much are you spending relative to your wealth, and over what time period do you expect to fund that goal? Is it a very short-term, one-time goal, or is it something perhaps like retirement where you're looking at several decades perhaps?
So of course, investors do not invest their money in a static environment. Things are always going on. The global markets, current events, politics, some of these things may impact the macroeconomic conditions in which people invest. Should investors react to these events, if at all, when thinking about their long-term strategy or their plans?
Sure, it certainly feels comfortable reacting in the moment. When you see headlines going on that give you cause for concern, maybe it's politics, maybe it's the economy, maybe it's something else. We always tend to be reactive. And that's partially tied to our survival instinct. Our brains are really primitive in terms of how they react, in terms of how they actually process events. You think about our ancient ancestors, they weren't thinking about interest rates. They weren't thinking about the federal deficit, what the new administration might do with taxes. They were thinking about day-to-day survival. And so when you look at the financial markets in terms of human history, the financial markets have really only been around for a small blip of history. The New York Stock Exchange, it's about 230, 240 years old. The earliest settlements we can find date back to 10,000 BC. So we're really a long period of time when we did not have to deal with the financial markets. So it's really important to realize our brains are not programmed to deal with Mr. Market's ever changing emotions. So it's really important not to react, to really think about, why am I investing? How far are those goals? But if you do have a significant change in wealth, one that might cause you to either reach your goal sooner than planned, or one that might cause you to miss your goal, at that point, it's important to stop and go back through. And so in the wealth building process, one of the final worksheets we give that are part of the toolkit is this portfolio review, and it is to consider, has there been a significant change in your wealth? And if there is, then we ask you to go back, reconsider the timing of your goals, reconsider your risk tolerance, and has that change in wealth been big enough to alter your goals? And keep in mind, it doesn't necessarily have to be a negative change. Maybe you sold a business, maybe you inherited a large sum of money, maybe you got really lucky and you won the Powerball or Mega Millions jackpot. Obviously a rare event, but there's some really big change that would cause you to reevaluate your portfolio. If the market's down, say 20% in a year, if you're allocated correctly for your goals, that should not cause you to have to alter your investment plan. It should really be a bigger change than just that.
All right, to wrap up, I just wanted to give a quick plug to the individual investor wealth building process, where you can learn more about how to establish your own investing goals and choosing an appropriate allocation, along with other steps you can follow on your individual investor journey. You can find that at aaii.com/learn-and-plan. Thank you, Charles.
Thank you, Ryan.
I wanted to welcome John Bykowski and Derek Hageman to the program. Welcome, you two.
Pleasure to be here.
Go ahead and kick us off.
Well, Derek, you've got a very interesting article in the January 2021 issue of the AAII Journal. And in it, you look at the hypothetical performance of over 50 different stock screening approaches that we've been tracking by the association. Can you tell our audience a little bit about what the purpose of stock screening is and why an investor might want to select stocks for their portfolio using that kind of approach?
Yeah, definitely. No, thanks, John. Yeah, that's correct. I wrote an article for the January 2021 AAII journal, and it's really a year in review article looking at the top and bottom performing screens for 2020. It also looks at long-term performance trends, and I try to attempt to identify some of the interesting market trends that happen throughout the year. And you know, it's actually one of the most anticipated articles of the year, and the title of the article, if you want to take a look at it, it's called An Unprecedented Year for Stocks, 2020 Review of AAII Stock Screens. So to your question about the purpose of screening, well, AAII, we've developed, we've tested, we've refined, and we've been tracking a variety of quantitative stock strategies for over 20 years. And many of these methodologies, they follow the approaches of popular investment professionals or gurus, you know, familiar names like Warren Buffett, John Templeton, Jim O'Shaughnessy, and others. They're tied to more basic investment principles. And these strategies they really cover a wide range of investment styles, from those that are value-based to those that focus primarily on price momentum and growth. Then there are several screens that fall somewhere in the middle. And investors that, you know, they might want to use a screen to help select stocks for their portfolio. And really, stock screening, it's a useful way of identifying potential investment candidates. And stock screening, it really allows you to narrow the universe of companies down to a more manageable group that you can then analyze more closely. I mean, the database that we use at AAII, it has over 6,000 stocks that we track, and really that universe is just too big. So stock screening, it allows you to narrow the universe down. And you know, stock screening strategies, they're intended to be an educational resource to show what types of filters and strategies work over varying market conditions. And they're really not portfolios, nor are they intended to be a buy or recommended list. You know, at best, you should view them as idea generators. That's really what they are. And you should analyze the passing stocks further before deciding whether to commit real dollars to them. So hopefully that answers your question, John, on why someone would use a stock screening approach.
It's very interesting. So with, like you've said, there's over 50 approaches, and they run the full gamut of value and momentum. So how would an investor go about selecting, you know, which strategy to follow, if any?
Yeah, no, good question. And like you said, yeah, with over 50 different screening approaches, there really is something for everyone. And you know, I mentioned earlier that several of the strategies they follow approaches of popular investment professionals like Buffett and Templeton. And there's screens following the approach of an investment professional. They don't, this is one thing to keep in mind, they don't represent that particular investment professional's actual stock picks, but there are rules. Each screen, there's defined rules, and the rules of each screen, they're defined by our interpretation of those respective gurus. So there are also strategies that are tied to basic investment principles that I mentioned earlier. And these strategies, they cover a wide range of investment styles. And those investment styles are actually called factor investing. And so factor investing, it chooses stocks based on attributes that have been shown to generate high returns. And there are 9 attributes that AAII uses currently. And these attributes, they've come to be called factors. And some of these factors include small stocks, which would be a size factor, low valuation, high price momentum, and high yield. And AAII has developed several screens based on these common investment factors. And for example, I mean, I'm a value investor, I'm also a yield investor. I'm the editor for AAII's dividend investing portfolio. So a yield investment strategy that gains exposure to companies that appear undervalued and have demonstrated safe, stable, and increasing dividends. So a successful company to me is one that can pay dividends regularly, and presumably they increase that rate as time goes on. And so screening strategies, they're tagged as yield if they specifically look for dividend paying stocks, as well as minimum absolute dividend yields, or stocks that are trading with yields above historical averages or sector or industry norms. So those are a few places that people can start.
But so investors or our members, if they go to our website, they can get a deeper set of information as to how a particular strategy was developed and the philosophy behind it and the factors that are used. So they probably, our members won't find that level of detail in the journal article, but certainly on our website, they will find that kind of information.
Yeah, definitely. The website, you know, the article is a starting point. It highlights a few of the different strategies, but for more in-depth information, absolutely, our website has all the, like I said, we have 60 screens currently. We have guru strategies. We also have the factor strategies, and within each strategy, we walk through what the strategy is and what some of the characteristics those particular strategies look for. Yeah, tons of information on our website.
And even the article itself had some wonderful tables. I noticed, I mean, there's a ton of information in these. I see, you know, there's 5 years of performance data. There's performance over bull market periods, bear market periods, volatility ratios, even statistics regarding how many stocks typically pass a given strategy. Any tips you'd give to our listeners as to how they might use that information?
Yeah, so I mean, that's correct. The article in the January journal, you'll see a lot of performance data. And like you said, there's year-by-year performance, there's long-term performance for each strategy. And how would I recommend a reader use this information? Well, let's see. First, I would say it's important to understand the investment characteristics of any approach you're using. And so for each of those screens that, like we just discussed, we have a write-up that goes into detail about the strategy. But second, and probably most importantly, in terms of any judgment concerning which screen appears to work best, I would recommend that you look at the long-term returns in addition to the year-by-year performance. And that the screen tracking results, they are really revealing. And if you want to examine the numbers, there's complete performance statistics that we present, and we also present how screens perform, like you said, under different market conditions, bull market, bear market, and we also present risk and return characteristics. And you know, I always have to say this, you know, just because one screen performed well one year doesn't necessarily mean it will perform well the next year. So, you know, remember that past performance, it's definitely no guarantee of future success. But to answer your question, when determining which screen you want to follow, you may want to ask yourself a couple questions. And one question might be, you know, how is the screen of interest reacting relative to the current market environment? So if it is deviating substantially, you know, you might want to look at what is the cause of that deviation. Is it the individual stock picks, or is it a deliberate over-concentration caused by the screen's investment methodology? Another question you might want to ask is, are the screen's characteristics more similar to a value-based or a growth-based approach? And really, you know, any screening approach that you follow, it should match your individual needs and risk tolerance. And third, and probably most importantly, remember that screening, it's really just a first step. There are qualitative elements that, you know, they can't be captured effectively by the very quantitative screening process that we present. And detailed fundamental analysis of any stock you're considering for purchase is necessary for successful investing.
Derek, you were talking about some effects that the market environment may have had on your screening strategies that you may follow. I'm just curious, obviously 2020 was an unusual market environment that investors faced. Are there any strategies that perhaps stood out last year? Have there been any consistently strong performers, or was there kind of a trend reaction to the market environment last year?
Yeah, I mean, so looking at strategies that stood out in 2020, yeah, definitely a few strategies stood out. And when I wrote the article, I actually used data through November 30th, and I'll focus on that top strategy for that period. And I will be doing an update article soon on data through the end of the year. But let me just focus on the top strategy. And like you said, 2020, it definitely wasn't a normal year. I mean, coronavirus, there was stay-at-home orders, there were mandatory shutdowns, social distancing. We experienced a bear market, and then we saw a massive stimulus from the federal government and the Fed. Markets rallied. There was also a presidential election. And then to finish the year, there was the vaccine hope. And so, yeah, I mean, in many respects, we've never seen a year like 2020. But for 2020, the top guru strategy, it was the InvestWare Quality Growth Screen. And so that's a growth-oriented factor strategy. And this approach, it led all AAII strategies. It actually had just over 100% gain for the first 11 months of the year. And let's see, what other strategies? For the third consecutive year, the foolish small cap 8 guru strategy. So that blends growth, momentum, and size factors. That was the second best performing approach of all 60 AAII stock screening strategies. If we look at the top factor approach for 2020, it was the return on equity strategy, and that was up 45.5%. And that's a commonly used measure of profitability and corporate management excellence. So, and just to go back to the InvestWare Quality Growth screening strategy, that strategy seeks to identify growth companies, and some of the things it looks at sales over the last trailing 12 months, and it's looking for sales greater than $100 million. It's also looking at companies that have been public for over 5 years, and just a few other things. It looks for growth in sales of at least 7% a year over the last 1, 3, and 5 year periods, as well as diluted earnings per share. Diluted earnings per share from continuing operations of at least near 15% over the same periods. So there's a couple strategies that stood out for 2020.
And I know it can be risky trying to follow, just the hot stocks or the hot trends. Are there any strategies that have a long-term track record of really doing very well?
Yeah, definitely, and I'm glad you brought up that point, because that is one of the questions you want to ask yourself is, has this strategy performed well over the long term? Any given year, a strategy can be the best performer, but it's really that long-term track record that I like to focus on. So, if we're looking at over a longer term period, 10 years or since inception, so many of our screens go back to 1998, actually, so over 20 years. But the top guru screen, and it was actually the top overall screen, was O'Neill's Can Slim revised 3rd edition strategy, and that actually overtook the stock market winners approach, and it moved to the top of the list, and it actually has had an average annual price gain of 16.6% a year over the last 10 years. And that strategy, it seeks companies with a history of strong earnings and consistent annual earnings growth, and history of strong sales growth as well, quarterly earnings momentum, strong relative price strength, and it also looks at it looks at companies that have support from leading institutions. So that's one strategy that's performed over the long term.
When it comes to, we've talked a lot about the buy side. When it comes to selling, is selling overrated or underrated? I mean, how important is the selling part of the equation?
I mean, the selling part of the equation, I think it's just as important as the buy. And so the way selling is viewed for stock screening is if a company, so the same criteria that allows a specific company to pass a specific strategy, well, we use the reverse for selling. So a company would be dropped from a particular screening strategy if it doesn't meet the certain specific characteristics. So we talked about the investment-wise quality growth. So it had to meet certain sales growth numbers, earning growth numbers. So if the stock no longer met those characteristics, it would actually be deleted from that particular portfolio. So it's really important to keep an eye on the selling criteria as well.
And really, when it comes to one of the things I found helpful with the screens when it comes to buying or selling is that, by having the criteria, it kind of gives you almost a checklist to kind of keep your emotions at bay. Why am I buying this stock? Why am I selling this stock? It's just a way to, kind of not get caught up in the emotional baggage that comes in owning it. And certainly, very often it's difficult to want to sell a stock because almost the minute you made a mistake, you're selling it for a bad reason. So the nice thing about having these filters or these criteria, these quantity, it just helps give you kind of a reminder of what to look for.
Definitely. I mean, they're quantitatively based, and like you said, it tries to take that behavioral bias that some investors may have. So definitely, it's helpful to follow a quantitative, have a quantitative focus.
Derek, the association doesn't usually go out of its way to make strict recommendations, but I was just curious if there are any stock screens that you might favor because they closely align or match with your investment approach.
Yeah, definitely. I do have my favorite investment styles. I mentioned earlier, I'm a big dividend investor, so I do follow a yield strategy. Another strategy that I like, I do like the foolish small cap 8. I like these smaller companies that may be under the radar. They don't have much analyst coverage. So I really like the opportunity of these smaller companies that just don't have much exposure and on their path to hopefully becoming larger companies. So I would say those are my two favorite strategies.
Derek, I really enjoyed your article and I enjoy all the work you're doing. Just as a kind of as a closing statement here, have you found any common characteristics that are there with the better strategies, or any kind of qualitative factors or quantitative factors that you kind of see, whether you're a Warren Buffett or a David Dreaman or a foolish small? Are there certain factors that kind of seem consistent throughout the winning approaches?
Yeah, I mean, specifically for 2020, but I think this is probably true over a longer term. But if you look at the most successful stocks for 2020, really the growth and momentum factors, they were the best. And actually, of the top 10 guru screens, they all had exposure to the growth factor. So I would say that's something. And just to help our listeners understand, I mean, stock screening methodologies, they're tagged as growth if they look for stocks, with a history of earnings increases. They also look for minimum levels of growth in sales, earnings, cash flow, etc. And they also have a minimum projected earnings growth. I guess a few other things I would just highlight that, following a multi-year trend, growth-oriented strategies, they've definitely done better at the large and mid-cap levels, while some of the value-focused strategies, they've value focused strategies, they've outperformed growth among small cap stocks. So those are a few of the common characteristics of some of the successful stock screens over 2020 and over the longer term.
All right, well, I wanted to thank you both for coming on the show and talking about this. If you'd like to read more on this topic, you can check out the January 2021 issue of the AAII Journal, and the name of the article is An Unprecedented Year for Stocks, 2020 Review of AAII Stock Screens. It's available on AAII.com. Thank you to you both.
Well, it's been a pleasure, and I wish Derek green arrows.
Thanks, guys.
All right, we'll be right back. All right, for this segment, I wanted to talk to you, Charles, about an article in the January 2021 AAII Journal from contributor John Deisher that covers whether investors are protected if their broker goes bankrupt, as was seen in the infamous Lehman Brothers and Madoff security situation in 2008. So let's start with the premise of the article. Are investors protected, and what should they do in this scenario?
So investors are protected if they're investing with a firm that has SIPC insurance. They should be an SIPC member. Most of your major brokers all are, but it really does not hurt to check. Just, you can check with the SIPC, but you can also ask your broker or look for the SIPC logo on their website. It's the same thing with a bank. You shouldn't put your money with a bank that's not FDIC insured. So that's really the big thing, is to look for it, and don't take someone's word for it that says I'm SIPC. Look for the logo, or better yet, go to the SIPC website and do a search to confirm they actually are part of the SIPC, because the scamsters are out there and they will say whatever you want to hear if they think they have a chance at grabbing your wallet.
The article touches on 4 situations in which the SIPC does not cover losses. Could you briefly review those type of investments that are protected and the situations where they may not be?
So certainly, so the big things is, A, if you're investing in an account that's not SIPC insured, you're not covered. Commodities generally are not covered unless you're buying them through an exchange traded fund. Private investments are not covered either, and it's really important to realize that, because you will have a lot of advisors that might offer you private investments, say perhaps a real estate transaction or something else, where it might sound really attractive, but you really want to make sure that it is actually a registered investment and not a private investment. So you want to do your due diligence on this. It's also not going to protect you against market losses. So you make a bad investment, the stock falls or the bond defaults, the SIPC is not there to cover you for it. It's there to actually protect you against fraud versus theft of your account, not because you made bad investing decisions.
I want to remind our viewers that you can ask us questions on the show, which we will read on air to get them answered. The following questions came in on this article. We'll start with this one from Norman R. He asks, would each mutual fund held in a brokerage account have its own SIPC coverage, since each is a separate legal entity? What do you think, Charles?
So the SIPC actually applies to the account ownership. So your IRA is protected separately than your brokerage account, which may be separate than if you have a joint account. So it's not looking at the actual individual investments, it's looking at your actual account is what it's protecting.
All right, this question comes in from Donald J. There's also a bit of a comment attached, so stay with us. All of the member SIPC firms quote that these seemingly large excess SIPC amounts, which are well beyond the size of most portfolios, you do have to dig to learn that, quote, in the aggregate means all accounts of that firm. I understand that my accounts are to be kept separate from the brokerage company, so as the brokers will tell you, it would simply be a matter of finding another firm to manage these accounts for you. But what if the customer accounts are mingled with a troubled broker's assets before a bankruptcy?
So the SIPC is there to actually protect your account. So in the event there is a bankruptcy, the SIPCs will make you whole. And their goal is to actually replace the securities in your account. So you say you have a stock and the stock was trading at $50 and it takes, we'll throw out a random number. It takes 6 months to resolve it through SIPC. And I don't know what the average amount of time actually resolve these things, but during that time, say the stock price jumps to $100, you're not going to get that $100 share price. The SIPC is going to try and make you whole as of the date the fraud occurs. Now, that's what the role is. Now, if the broker is doing some misdeeds, then the broker itself could be violating regulations, but the SIPC's role is to make your account whole at that moment. So that's their goal. What the broker's doing is, in terms of violating regulations, may be separate, but the SIPC is there for your benefit, not for the benefit of the broker.
Gotcha. And then this one came in from Dan M. He asks, and this is maybe a two-part question, are brokerage clients protected from theft of their assets, for example, having their account hacked? It sounds like the SIPC protection does not apply in this situation. How do brokers address this risk?
So the SIPC actually does protect you against theft. So in a case where if it doesn't, so if someone's breaking into your account, say through cyber means, and they're stealing your account, that's what the SIPC is there, is actually to protect you against theft. Now, you could certainly talk to your broker about their own security, what steps they're taking. I would also encourage you, however, if you're transacting online, have a different password for each account, and make them nonsensical things. Now, it could be something that makes sense to you. Maybe it's paint, basement, fan, pink. Maybe you're painting pink fans in your basement or something crazy like that. But make sure you put a number by it too. Maybe it's, $4765 ampersand or something like that, where for each one to be different. So have the passwords so it's not very easily guessed by somebody. 1, 2, 3, 4 pass is obviously a really bad password to use.
Sure.
But vary it by each account. And I've talked about this before. I'm a big believer in password management programs. I myself use Dashlane. There's another one that's LastPass. And sometimes I joke that if someone was to hold a gun to my head, I could not give them the password to my bank account. I literally do not know what it is. I have it say in the password manager. It's a mix of numbers and letters, but it's safer that way because, again, it's not something that's easily guessed. Now, is any password completely safe? Absolutely not. It's really a matter of reducing your risk. And I can't stress this enough. If you get an email, never click on the link in an email to your financial institution. Go to your financial institution's website. If you have an account with Chase, go to chase.com. If you have an account with E-Trade, go to eTrade.com. If you're Merrill Lynch, go to merrilllynch.com, etc. Go directly to their websites, type in those names, do not click on emails. And if somebody calls you asking for personal information, hang up the phone. Better yet, if somebody calls and you don't recognize the number, don't answer it. If it's really important, they'll leave a message for you to get back. The scamsters are looking for opportunities to get at your personal information. It's your job to make it really hard for them to do so.
Some really solid advice. Thank you, Charles. To read more on this topic, you can check out the January 2021 issue of the AAII Journal and the article, which is titled, Are You Protected If Your Broker Goes Bankrupt? That's available as well on AAII.com. Thank you. We'll be right back.
Thanks, Ryan.
If you liked our show, please visit AAII.com/webinars to register for more webinar and video content. You can like us on Facebook and follow us on Twitter at AAII_invest_ED. For more investing education, I invite you to check out our website, AAII.com. Again, I want to thank our guests, Charles Ropla, John Bykowski, and Derek Hageman. And you for listening. We'll see you next time on the Individual Investor Show.